Hello everyone, this is Satish Kumar. I am here with another lesson for Indian economy. So this is my lesson, continuation lesson on banking. So in this lesson we are going to learn about the capital adequacy ratio and the Basel norms. Okay, I consider this as a very important lesson. Not only I, generally at present situation where the banks are incurring lot of NPAs, the capital adequacy ratio, sorry I have written as ration, that is wrong, ratio, okay, and the Basel norms become all the more important, okay. In fact this is a very important topic. See, banks are generally very important for the present society, okay. In fact they play a major role in our present system of economy, the modern economy, and they are considered as a backbone, okay, and a proper functioning of a bank is a must for a healthy economy. If banks fail, it will have a very big impact on the economy, okay. See, generally there are multiple institutions. Failure of any institutions will create problem in an economy, but a banking system failing will have far greater impact than any other failure of an institution, because banks, a lot other institutions are dependent on bank, okay. That is why we are saying the importance of banks, okay. So banks should not fail, and if banks fail, it will affect the economy to a great extent. That is why governments all over the world are paying very special attention to regulate the banks, okay. So the aim of this regulation, the banking regulation, is basically to ensure that the banks maximize their credit, that is they earn more profit, and at the same time they minimize the risk, okay, so that they don't default, banks don't fail, okay. So and function and continue to function permanently. These two are the major aim of the banking regulations. In fact, both the government and RBI involves in banking regulation, okay. And see, we cannot avoid risks in bank. The way the banks are functioning, there is always chance for some failure, that is banks to incur some losses, okay. For example, if a bank is lending loan, there are probability of chances that the lended amount may not return. There are chances. In fact, the risk that is estimated is up to 50%, okay. If bank is lending 100 rupees, even 50 rupees may not come, that much of possible probability is there, okay. So banks cannot avoid the risk, but at the same time bank has to function, okay. So the bank has to minimize this risk at the most possible, and it also have to maximize credit creation in the economy. In fact, bank saying that we are incurring lot of losses, so we are not going to lend, okay, we are going to be very prudent and we are going to lend very less, no, that will also be not good to economy. So the banks have to lend more, at the same time they have to ensure that they don't involve in too much of risk. That is the reason for the banking regulation, and banking regulation focuses on this, okay. So it has to balance these two aspects. At one end it has to balance that banks do not incur losses, and at the other end it has to focus on creating more credit, okay, because the function of the banks is to bring to help the economy grow. For that the banks has to function at the best optimal level. It has to lend more, okay, only then that will happen. So these two objectives has to ensure, so that the banking regulations will be accordingly, okay. So, in order to achieve these both these aims, no, banks, the central banks, especially in India, RBI. Similarly, all over the world, there are federal bank. In USA, it's federal bank. Okay, like that, there are central banks are there. These central banks started to devise tools so that they will avoid risk, to minimize the risk, and also to provide some cushion or shock absorbers to banks to meet any risk that happen, okay, so that the bank will not go bankrupt and shut down. Okay, so the central banks have devised certain tool. In fact, we learned the RBI functions, where RBI is doing a lot of work, where we learnt about things. So some of those functions are related to this. Okay, the central banks do certain things. So what are all the things? So three important things have developed over the years that RBI has developed as cushion or shock absorbers to banks to reduce the to meet the risks, okay, the risks that bank face. One is the cash ratio. In fact, if a bank gets 100 rupees as deposit, no, it has to maintain some amount of that 100 rupees as cash ratio. It cannot lend the entire 100 rupees. It has to maintain some amount as cash reserve ratio. Okay. In fact, in India it is cash reserve ratio. Okay, that is the first provision. So this amount will always be there. So sometime if somebody tomorrow, some depositors come to the bank to withdraw some money, this reserve will always be there, so that it could be helped. Okay. The second is maintaining some assets of the deposit with the banks themselves in non-cash form, which will be liquid, which will be a liquid asset. Okay. What do we mean by liquid asset? See, cash is the most liquid. In fact, cash is immediately usable. Okay, but bank, when it is keeping it as cash, no, it is an idle money. So the bank need to earn some profit of its assets. So it has to invest somewhere. But at the same time, this investment, this asset investment, no, should be easily be converted into cash. That is what called as liquid asset. Liquid assets, the major term is it could be easily converted into cash without losing much value. That is also very important. Without losing much value. Any asset could be converted into cash, but we have to lose the value. Okay, you have bought a bike 1 year back, and today you want to sell that bike. Okay, that bike could be easily sold, but the buyer will pay you only very little amount of money. Okay, it could not be called as a liquid asset. So he may ask for a dead price. For example, you might bought for 50,000 and he might be willing to sell it for 30,000, but the person may ask it for 10,000. So that asset could not be called as a liquid asset. Okay, so any asset, when it is when they try to liquidate it or to convert it into cash, no, it has to not to lose the value. That is called liquid asset. So the second provision of the central banks that they prescribe to banks is to keep some assets in non-cash form that is highly liquid in nature. So that is called the SLR in India. Okay, statutory liquidity ratio. We keep such an amount. In fact, you know what India they will mostly invest in government securities, because government securities are highly safe and highly liquid in nature. Okay, that is why they spend there. Okay, the third provision is the capital adequacy ratio. Okay, that is the third part. We will see what is the capital adequacy ratio today. Before seeing what is capital adequacy ratio, we will try to understand why the maintained capital adequacy ratio. In fact, the aim is to meet any situation that is that is risk to the bank. Okay. So generally, two reasons, so that banks helps to prevent some bank failure. This assets, the capital adequacy ratio, no, will help prevent from bank failing. Okay, suppose if the bank is suddenly incurring some huge losses, no, this capital adequacy ratio will come handy to meet that situation, and the bank will not fail and it will continue to function. That is the major reason for capital adequacy ratio. So we have seen the importance of banking in the introduction part itself, that bank cannot fail and it should not fail. So the capital adequacy ratio is very important, that it will help banks to prevent from bank failure in case of any losses that bank undergo. Okay. The second is, if a bank doesn't have enough capital, no, it will it will it will make the bank feel what you say, the net worth of the bank will come down. It will have a negative net worth. Okay, and this will also not help in case of any bad situation. Okay, and the amount of capital will affect the owners, that is the equity holders, because when a bank is sound with its capital, no, it will earn more profit. Okay, a bank which is said to be functioning at the best without any losses and with having enough capital adequacy ratio, people will be trusting that bank and they will be investing, depositing more, and that will bank will reap more profit. Okay, so it will affect. So these are the reasons the capital adequacy ratio become more important. Now we will see what is capital adequacy ratio. Okay, so we have so far seen the need for capital adequacy ratio, so we don't need to go there. So this was actually, capital adequacy ratio is first prescribed by the central banking bodies of the developed countries. Okay, in fact, at a place called Basel, the place Basel is located in Switzerland. Okay, here in 1988, the people in the central banking bodies of different countries, developed countries especially, they assembled here and they came up with this idea of capital adequacy ratio. Okay, because it is they developed this idea in this Basel, it came to be known as Basel Norms or Basel Accord. Okay, since then they have come with 3 norms. Okay, the first they came in 1988. Okay, and the place where they assembled is the place was the Bank for International Settlement at Basel. Okay, where they assembled and where they came up with this idea. Okay, so initially by the Basel norms, they decided that there should be 8%, okay, of capital adequacy ratio. Okay, so what is this capital adequacy ratio? See, it is nothing but formulas given: tier 1 plus tier 2 capital divided by risk weighted assets. Okay, this tier 1 and tier 2 capital will be the capital that the bank have to maintain. Okay, the capital adequacy ratio is this, the tier 1 and tier 2 capital. How it is measured? In the 1988, okay, later this idea changed, but initially tier 1 plus tier 2 capital divided by risk weighted asset. So they decided initially the tier 1 and tier 2 capital should be 8%. Okay, we will discuss what is tier 1 capital, what is tier 2 capital, and we will also discuss what is risk weighted asset. Okay, so for example, if a bank is lending loan to its people, to the borrowers for 100 rupees. If they are lending 100 rupees, okay, and it has to maintain a capital of 8 rupees, okay, that is the initial setup. Now we will see what is the tier 1 capital. So the tier 1 capital is nothing but the paid up capital of the banks. If suppose a bank is promoted by someone, okay, there will be some paid up capital, right? The bank has been set up by investing some 100 crore, okay, and there will also be equity. The bank might have raised some equity capital from the share market, so that amount will be there, okay, and the bank may also earned some money over the period of their operation, okay, and they might have some revenues, the disclosed revenues, okay, so that amount will be there, and they may also possess some statutory reserves. So all these amount are considered as tier 1 capital. That is the paid up capital, that is the initial capital, then the equity capital that they raise, and the any disclosed revenue reserves of the bank, okay, the bank that which it earns profit, only the disclosed revenue. Bank usually also have undisclosed revenue, so that is not included in the tier 1 capital, okay. So these are all part of the tier 1 capital, okay, and please remember the tier 1 capital is the highest quality, that is it can be easily liquidated. It is the highest quality of asset. So this asset is what you say, a safe asset for the bank. It could be easily converted into cash. Hence this tier 1 capital is called as a asset that could be able to absorb any losses that the bank may undergo, okay, and it will help if suppose the bank is facing a serious crisis, and if this tier 1 capital is enough for that to solve that crisis, so the bank will be able to solve that problem, and it will continue to function, okay. So the bank will not be forced to stop operating. So this is the major thing about tier 1 capital. It is a highest quality capital. So what are the capital that is included here? I have said paid up capital, equity capital, and disclosed revenue reserves, okay. Then there is the tier 2 capital. So it comprises of undisclosed reserves of bank and preference shares, okay. In fact, if you watch my equity lesson, share market lesson, you will know the difference between equity share and preference share. I will put a lesson later because I have not yet uploaded it, but there is a difference between equity capital and preference share, okay. So undisclosed reserve and preference share and subordinate debt, okay, that is mortgage based debt, which are also part of bank capital. So these all will be part of tier 2 capital, okay. And please remember the tier 2 capital is considered as only supplementary, and it is not as high quality as the tier 1 capital, and it is not easily it cannot be liquidated so easily. That is why it is called as less reliable. It cannot meet be able to meet sudden situations. It cannot be easily liquidated, okay. And also remember this point, this capital will come handy only in case of to meet, suppose the bank is defaulted and the bank has to end the operation, and in such situation it could be helpful, so that it provides some protection for the depositors and creditors, okay. This capital will not help much in the continue to functioning in the bank. The bank keep on functioning, okay. That is why it is put under the tier 2 capital, okay. So it provides a lesser degree of protection. It is not as highest quality as tier 1 capital. Please remember these 2 points, okay. These 2 capitals are added, and they are divided by the risk weighted asset to capital, the capital adequacy ratio. Okay. So now we have to know what is the risk weighted asset. Okay. See, the bank is lending loan to people. Okay. It is lending loan to lot of people. They may lend to an individual, they may lend to a corporate, small business, big business, corporates, they may lend to government. Okay. So banks lend to lot of people. All this lending amount is called as asset of bank. Okay. And all these assets carry different uh, uh, different risk. For example, if a bank is lending to a government, no, the risk is very less. That is, there won't be any risk. That is 0%. But if a bank is lending to an individual, okay, somebody like me, okay, the chances of me failing is 100% because I am not going to give any collateral to that bank. So suppose if I fail or if I suddenly I am dying, the 100% chance of what you say, the risk is there for the bank. Okay. So there are different profiles of risk associated with the different loans given to the people. Okay. For example, a company might be taking loan from a bank by giving a letter of credit. Okay. That is by promising to the bank that they will get this amount of loan and it will pay later. Okay. Similarly, a company may borrow money from the bank by pledging some asset as collateral. For example, pledging their house, okay, or some gold like that. In such cases, the bank has some collateral. So that loan carries very little risk because they have some collateral. In the first case, the risk is higher because the only he is giving a letter of credit. If he fails, the risk is high. Okay. So the risk of different amount that is lended, no, different weightages are there. So based on this, a weighted average is arrived. So whenever a bank is lending loan, no, each asset, each value that is lended to different type of people will carry some risk. Based on this, a weight is assigned to each asset, okay, each loan that is lended, and based on that, an average risk weighted asset is arrived. For example, if bank has lended 100 rupees, no, for this 100 rupees, take it has lent to 4 people. This is just an example. Okay, one is to an individual, one is to a government, one is to a corporate with risk, and another is with a corporate with collateral. Okay. So the first guy will have 100%, individual guy will have 100% risk, and the second guy, that the government, will have 0% risk. The third person, that is the person who gave letter of credit, no, he will have risk, more risk, for example 50%, and the fourth guy, that is who gave the collateral, no, he will have somewhere around 20% only risk. Okay. So if you add all this value, no, 4 divided by what will be the value, 100, 150, 170 divided by 4, some 40% something come, right? That is the risk weighted asset. So 40% of the loan might become risk, not the entire 100 rupees that is lent. 40 rupees might be as a risk. So this amount will be the risk weighted asset. I hope you understand the concept of the risk weighted asset. Okay. Please remember this one. So this is how the capital adequacy ratio is derived. Okay. So the Basel norms, we have seen that when the capital adequacy ratio, when they came up, it was the Basel, it's a place where this idea was initially they actually issued this norms, Basel norms, and in that this is done by what is known as Basel Committee on Banking Supervision. Okay. So their effort is to coordinate the banking regulation across the globe. Okay. So the Basel Committee on Banking Supervision will come up with this norm. Okay. And it is headquarters in the Bureau of International Settlements in Basel, Switzerland. Okay. Their office, it's Basel Committee on Banking Supervision offices, Bureau of International Settlement at Basel city in Switzerland. That is why it is called Basel Norms. Okay. So it is the Basel, the Bureau of International Settlement was set up in 1930. Okay, and the Basel Committee on Banking Supervision is housed in the Bureau of International Settlement. So please remember this difference between Bureau of International Settlement and Basel Committee on Banking Supervision. See, Bureau of International Settlement is something different. It helps, it gave a platform for the central banks, different central banks to assemble and to discuss about the financial, to develop a goal for financial stability. But the Basel Committee of Banking Supervision is the organ which comes up with the Basel norms. Okay, it is not the Bureau of International Settlement. They give this platform. In fact, the Basel Committee on Banking Supervision helps it function in the Bureau of International Settlement. Okay, please remember this point. So the Basel Committee on Banking Supervision is the organ which is a primary organ which set the global standard for regulation of banks, prudential regulation of banks. And so here this important all the central bank governors for central bank chiefs of different countries, okay, come and meet here. Initially in 1974, the Basel Committee, when it was on banking supervision, when it was formed, no, please remember this point, Basel Committee on Banking Supervision was formed in 1974. At that time there were only 10 countries, all are developed countries. Okay, at present, even at present also, at that time it had only 10 countries, at present it has 45 countries, and India is at present part of it. Okay, please remember this 45 members, India also participate in this meeting, the Basel Committee on Banking Supervision, to discuss. For example, our RBI governor will go. Okay, the central bank head means our RBI governor. Okay, so they will go and discuss about how to regulate the banking system. Okay, and the major aim of this Basel Committee is coming up with norms is to provide some supervisory issue and improve the quality of banking supervision worldwide. Okay, so far this committee, Basel Committee on Banking Supervision, has come up with 3 norms. What are all the 3 norms? Please remember, this is the Basel Committee that it is coming with these norms. No, it is called as norms. So norms is not something which has to be followed. Okay, so naturally a question arises, what if the country's Basel is given a norm and a country is not following, whether that country will be punished or not. Okay, whether a country is failing to implement. Okay, if you see the 1988 Basel came up with the first norm, but I think India adopted it only in 1999 or 97, something like that. Okay, so there is no obligation on the part of the countries to follow the Basel norms, they implement the Basel norms. Anything that is said is norm, it can be, it is not must. Okay, so these are all norms or standard set of rules, but it is up to that country to implement or not. Okay, and there won't be any penalty, okay, for not attaining these norms. But however, there won't be any direct penalty, but following these norms will be good for the country, and it will be helping in the international forum when the country meets. We will look at a better standard. Okay, for example, if there is an international institution which is giving rating for India, no, it will take into consideration whether India is following the Basel norms or not. Okay, if India is not following the Basel norms, they will not give better rating to India. If India follows the Basel norm, they will give a better rating. Okay, that is how it will affect. Okay, so direct penalty will not be there for not implementing the Basel norms, but it will have its own effect when India deals with some sort of diplomacy holdover. Okay, so it is better to follow these norms. Okay. So the Basel first norms was introduced in 1988. See, there are three types of risk that bank faces. Okay, that is credit risk, market risk, and operational risk. We will discuss each risk separately. Now we will understand what is credit risk. Credit risk nothing but the borrower failing to repay. That is credit risk. There will also be market risk. There will be sudden swing in value of money in the market, something market changes. Okay, so that will also, that kind of risk will also be there, right? Then there will be operational risk, that is the banking, the functions that from they may incur some risk. Okay, so there are multiple risks for banks. The three risks are there, but the Basel norms that is introduced in the 1988, the Basel first norms, no, it focused only on the credit risk, that is the possibility of a borrower failing. So that is why it came up with only 8% of risk weighted assets. It said that the capital adequacy ratio is 8% of risk weighted asset. Okay, please remember this point. And this also did not discuss in clear concept how much there should be tier 1 capital, how much there should be tier 2 capital, like that. It is not discussed. Okay, it only discussed about 8% risk weighted asset. Okay, and it only consider about the credit risk. In fact, it introduced in 1988. India adopted the Basel I guidelines in 1999. Okay, then the Basel set a new set of guidelines in 2004, which came to be known as Basel II norms. Okay, here it increased the, although it didn't increase the capital adequacy requirements, it provided a much far scrutiny for the banks. So for example, it is based on three pillars. The first pillar is the capital adequacy requirements. Here it said that bank has to maintain a minimum capital adequacy requirement of 8%. But it clearly specified that the tier 1 capital should be 4%. We saw the tier 1 capital, what is tier 1 capital and tier 2 capital. See, banks, when they are set to maintain capital adequacy, no, they will maintain a lot in the capital, tier 2 capital. For example, 7% tier 2 capital, and they may add only 1% tier 1 capital. That won't help, because tier 1 capital is the capital that will help the bank to continue functioning. So this clearly stated that there should be 4% tier 1 capital and the tier 2 capital should be 4%. Okay, it said like that. And it also said that the second pillar of this norms is supervisory functions of bank. Okay, it said that the banks need to develop and use better risk management techniques, that is monitoring and managing all the three types of risk that the bank will face. So here it consider all the three type of risk, that is the credit risk, the market risk, and operational risk. So this is the difference between Basel I and Basel II, because Basel I focused only on credit risk only. Here all the three risks are taken care of. Okay, then it also gave the third pillar, that is market discipline. That is, the bank should disclose, be more transparent. The bank should be more transparent. That is mandatory disclosure of their functioning. That is how much they have cash adequacy ratio, what is the, for example, whether they are having enough tier 1 capital, tier 2 capital, what is the risk exposure, how much of risk weighted assets are there, whether it is transparent, what is the real risk exposure, all this has to be disclosed by bank. The bank also should be transparent in its dealings, so that it will help to solve the problem. For example, a bank say that I am having 8% capital adequacy, but it won't have enough tier 1 capital, so the bank might face some risk. So that is why market discipline, that is the bank have to disclosure, mandatory disclosure of all these facts. Okay, so these three are the pillars of the Basel II norms. Okay, please remember, India has yet not implemented the Basel II norms, but the present system, the Indian banking system that is regulated by RBI, no, it is far better than the Basel II norms. What do I mean by that? Okay, the kind of regulation that we have in India is better than the Basel II norms that is prescribed by the Basel II norms. That is why when the Basel committee people, Basel committee for banking regulation settlement, those people know Basel committee on banking supervision, when they come to India to supervise how India is functioning, no, they always say that the kind of system that India has in the form, the norms that the Indian banking system follow is far better than the Basel norms. Okay, that is why India, despite it is having so much of non-performing asset, our banking system is yet to fail. Okay, please remember these kind of points. See, in 2008, we all know, despite Basel II norms was there, in 2004 itself it was there, but in 2018, the world witnessed the financial crisis, right? So suddenly, in fact, that has happened because of a huge bank, investment banking, that is Lehman Brothers, which is the bank which failed, and as a result, the financial crisis started. So now, the Basel committee decided that the Basel II norms is not sufficient to what you say, to meet the financial the crisis of any bank failure. So the Basel II norms is not enough, the Basel II norms. So they decided to come up with new norms. So that is the Basel III guidelines. They came up with this in 2010. Okay, after the financial crisis, they came up with this Basel III norms. So see, the reason for the 2008 financial crisis is banks in the developed countries, especially in the developed countries, are undercapitalized. They are not having enough capital, and they are over leveraging. Okay, this term is very important. Over leveraging. They are having very little capital, but they are over leveraging, and they are also relying on greater reliance on short term funding to meet any risks. So because of these three reasons, they are undercapitalized, and they are over leveraging, and they are relying on short term funding to meet the risk. No, that is why the bank in the developed countries failed. Okay, hence they wanted to come up with a new set of norms, that is the Basel III norms. So that they wanted the quantity and quality of the capital to increase, to be sufficient to meet this kind of problems. So they wanted capital, high quality and quantity, high quantity of capital, but also the high quality of capital. For example, short term funding will not be useful to meet risks. There should be funding that comes or is a regular source to the banks. Okay, so they came up with 4 vital banking parameters, that is capital, leverage, funding, and liquidity. We will see each and everything in this. So the first is the capital adequacy ratio. Here it asks to increase the capital adequacy ratio up to 12.9%. Okay, in fact 10.5% is the correct thing, but 12.9%, please remember this. Okay, so it said that the minimum tier 1 capital ratio should be 6%. So please remember this point. It has increased the minimum tier 1 capital from 4% in the second Basel norms to 6%, and it also increased the tier 2 capital. It did not increase the tier 2 capital, it decreased the tier 2 capital to 2%. So you might ask, so 6% plus 2 is also 8, and 4 plus 4 is also 8. So where is the increase in capital adequacy ratio? Okay, so the Basel committee said banks should have an additional of capital conservation buffer as 2.5%. Okay, an additional capital apart from this tier 1 and tier 2 capital. So with this, there is 10.5% of capital is there. Okay, and it also increased a new concept called counter cyclical capital buffer. Okay, to be maintained at from 0% to 2.5%. Okay, see, this counter cyclical capital buffer is not a requirement to be maintained at all time. It need to be maintained only during cyclical pressure, counter cyclical. I will discuss what is counter cyclical. You know what is the trade cycle in business, no? So based on that, we will discuss what it is. But at present, remember, the banks also have to maintain a counter cyclical buffer of from 0 to 2.5%. So it almost based on all these this three capital adequacy, there is 13%, that is 12.9% of capital that banks have to hold. So the capital has increased, okay, by the Basel III norms. Then the second thing about Basel III norm is, so before going to the second thing, let us understand what is counter cyclical capital buffer. See, banks will have period of boom and will have period of, like any business, sometimes the bank might be lend more. Okay, there may be good time for banks. Okay, when people are borrowing more. Okay, so the bank business will be high. At that time, bank might be forced interested in selling more, that is providing more loans. That is more because people might be borrowing more at higher interest rate, so the bank business will be high. So the bank will be keep on lending. Okay, that is what happened in US in the 2004-5. In those times, no, banks started lending more and more to real estate. Okay, good times. Okay, but they didn't have that much of capital for those the kind of asset. The expectation was it will return, but suddenly at certain point of time the real estate market fall and people were not able to repay and banks failed. Okay, and bank could not raise enough capital to meet the situation. That is how that bank failed. So what Basel III norms said is, banks, when it is lending more, that is during the good times, right, at that time it has to maintain an additional capital called counter cyclical capital buffer. That is during the good times when banks are lending more. Okay, because in future there might be a situation which might reverse, that the people who have bought now might default like that, right? So whenever bank is lending more, when the bank business are going high, in such situations banks have to maintain an extra percentage, that is up to 0% to from 0% to 2.5%. Okay, an additional that is what counter cyclical capital buffer is. Okay, and during the period of credit contraction, that is banks are not lending enough, no, at that time bank no need to maintain this amount. Okay, please remember, at that time they need to maintain this capital buffer. So at that time they could use this capital, this 2.5% to lend. They need to maintain this. Okay. So for example, Indian RBI said that in 2015, after the Basel III norm came in 2010, that India also should meet this counter-cyclical capital buffer. But the uh, it it said that we have to also maintain counter-cyclical capital buffer, but so far this ratio is kept in India at 0% because India is not lending that much. Okay, like the huge lending is not happening, so that is the reason why it is in the 0% for India. That may not be continuously. For example, tomorrow when banks lend more, that time RBI may ask to maintain a counter-cyclical capital buffer. So this counter-cyclical capital buffer is based on the situation of the bank. When bank is doing high business and booming, at that time it has to maintain. And bank is lending less and it is not, it is going into contraction, they could relax this counter-cyclical buffer, capital buffer. They could not have or have lesser amount, for example 1%, like that, right? That is what counter-cyclical capital buffer is. Okay. Now the second major thing about Basel III norms is leverage. Leverage is nothing but buying asset with borrowed money to multiply the gain. Okay. So the basic belief behind this is that the asset will return more to the investor and he will pay that interest. Okay, I'll give an example. See, a bank might lend money from somebody. Okay, for example, it might lend money from somebody, 100 rupees it is lending, and it is from this, it is borrowing this 100 rupees for someone, and then it is lending this 100 rupees to somebody. When it is borrowing the money, it might pay to that borrower, say 10% interest, and when it is lending, it will lend for 12% or 15% interest rate. So the bank here earns more, 15% interest. When it is borrowing, it is only paying 10%, so it will make profit. So this is what is called as leveraging. Okay, and the problem here is, see, when bank lends to somebody, there is chance that the borrower might, the borrower from the bank, he might fail, but the bank has to return the money to its borrower. Okay, because it is leveraging. What happens if the bank fail? If the borrower from the bank fails and the return is not there? That is what happened in US. Banks were leveraging so much, they are running by undercapitalized method. Suddenly, this is risky business. So the Basel III committee said banks should leverage only up to 3%. So they put some limit on bank over leveraging. So please remember, banks can leverage only up to 3% by the Basel III norms. Okay, I hope you understand this concept. Okay. The third is, by the Basel III norms, it came up with liquidity. So the Basel III norms said that banks should have two liquidity ratios. One is liquidity coverage ratio, that is, it have to have a buffer of high quality liquid asset sufficient to deal with cash outflows encountered in an acute short term stress scenario. See, at some times borrowers might be borrowers during certain times, the depositors to bank, that is the people who deposited in the bank, suddenly they might be coming to bank to withdraw that money. there may be plenty of situations, like suddenly the bank might be facing some issues. As a result, suddenly all the customers want to withdraw that money. So this process is known as bank run. Okay, whenever there is some financial crisis like situations, no, whenever bank is facing some issues, people will try to ensure their money is safe, so that they will try to withdraw that money from the bank. Okay, so this process is known as bank run, that people going to withdraw their money. Okay, and these are all extraordinary situations, and any these kind of short term situations, to meet these kind of situations, no, bank should have sufficient capital to meet these kind of situations. An excess of amount suddenly wanted to be withdrawn by people. Banks would have some capital to meet regular requirement of withdrawals, but suddenly people, because of certain situations, when they are running to bank to withdraw that money, no, and such situations banks will. So this, the bank should have at least for 30 days to meet this kind of extraordinary situation. That kind of ratio is called as liquidity coverage ratio. So they have a buffer of high quality liquidity assets up, so for 30 days. Okay, that is called liquidity in the Basel III norms. Okay, so that will meet the bank from defaulting. That liquidity coverage ratio will help the bank to not to default even when suddenly people are withdrawing their money. Okay, so that is called the liquidity. Then they also talked about funding, net stable funds rate. Okay, so here we saw that banks are leveraging by using short term funds. That is, banks are borrowing money to meet and to lend money. No, they are borrowing money in short term market. Okay, rather than they should be borrowing money that is stable funds. In fact, they should have borrow money from a stable source, which should be relied for a 1 year period. Okay, so that they will have some security to return the money. For example, they are borrowing, say, for a 30-day borrowing. They are borrowing from somebody saying that we will repay in 30 days. In such cases, if suppose tomorrow somebody is failing, bank has some problem, they cannot pay. But if they have funds that they are buying, no, which is stable fund up to 1 year, then there is some security. That is what the net stable funds rate. They should maintain a stable funding profile in relation to the off balance sheets. Okay, so please remember these 4 points. That is the pillars of the Basel III norms. Okay, the Basel III norms also came up with another thing called globally systematic important banks. Okay, what is GSIBs, also known as GSIBs? That is, some bank in the world are so big, okay, so that, and how big they are, if those banks fail, no, it will affect not only that country, that economy, it will affect overall world. For example, when in 2008 Lehman Brothers failed, it was a financial crisis for the entire developed countries. World, it had impact all over. So these kind of banks are considered as globally systematically important banks, or GSIBs. So based on the size and the interconnectedness of different countries and complexity of the business that they do know, banks are rated as GSIBs. And these GSIBs bank, the globally systematically important banks, no, they have a stricter regulation, prudent regulation, that is not applicable to normal banks. In fact, the Basel III norms we saw so far, no, those are all applicable to normal banks, but the globally systematic banks has to adhere to stricter principle than the normal banks. So additionally, these banks have to go to higher capital requirements and extra surcharges and more stringent tests. Okay, So because a failure of those banks will have far reaching impact. So that is why the Basel III norms came up with this idea of global systematically important banks, or GSIBs. Okay. Do you know how many banks are there in from India in this GSIBs? None. So India is not having such a huge bank which will impact the world. So the Basel committee has not included any one bank in this profile. So India has decided to include its own DESI SIBs, that is DSIBs, domestic systematically important banks. Okay, so the Reserve Bank has issued the banks that are very important for the Indian country, the big banks in India. Okay, so we are not having banks that are globally big, but in India there are some banks which are big. No, they are called as the domestic systematically important banks. This is given by RBI. At present there are 3 banks, SBI, ICICI and HDFC in the DSIBs, and these 3 banks will have to go through this high stricter regulations. Okay, because failure of these banks will have very bad impact in our country. Okay, so please remember what is the GSIBs and DSIBs. So finally we are coming to the Basel III implementation. As said earlier, it is not obligatory on any country to implement the Basel norms, but there is a voluntary implementation. In fact, India said that it will initially after that came the 2010, no, it planned to implement it on 2015, but it was pushed back. Okay, and it said that it will implement in March 2019. Okay, and suddenly in March 2019 we faced the COVID 2019, and as a result once again it was postponed to March 2020. Okay, and in fact when it was planned in 2019, once again it was postponed to March 2020, and in March 2020 we faced the COVID, and once again it was postponed. So at present the final deadline is 2022 for India, but India said so far we have at present because of the coronavirus we have declined for postponed it for some period. So when it is going to be implemented is yet to be seen. Okay, and so that is the present situation. So because of this delay in implementation, it also gives some breathing time for the NPAs, the banks that are facing the NPAs. Okay, and with this time a bank, if it solves all the NPA issues, it will be very easy for following the Basel III norms. Okay, because when Basel III norms is introduced for Indian banks, no, it will become more tougher for the banks which are facing NPAs. Okay, so this is about capital adequacy ratio and Basel III norms. I hope I have given as much information as possible. Try to learn about it. Very, very important topic as far as civil services is concerned, both for prelims and mains. They may ask some question related to any aspects. Try to have a very conceptual understanding and also some basic facts related to which year which norms came, what is the current status of India about each norms. Okay, and what are all the different features of different norms, like that. Okay, a very, very important topic. Please keep watching my channel. If you like the videos, kindly like it, subscribe my channel, and also share this with your friends. Bye.